guys, welcome back to the Money Is Show, and this week we have a special guest on the show all the way from my favorite town in America called Franklin, Tennessee. If you've never been there, you got to go. I want to probably move there one day, but today on the show we have Tom Laune from Franklin, Tennessee. Tom Laune is the creator of Bulletproof Wealth strategy, and we're going to break it down into 3 simple steps for you that he uses that I am passionately believe in. I've used these 3 steps. I think you should look at them in your real estate career. You should look at them in your business career. You should look at them for your part of your life legacy as you build it out. And one reason that I love working with Tom and I want to have him on the show is there's a lot of people that talk about this that are great at their job. But Tom, if you ever see those people that have like a doctor that has like all these letters behind their name, Tom is one of those guys that has the most amount of letters behind his name, especially when it comes into what we're going to talk about today in the Bulletproof Wealth strategy, the financial world, the insurance world. He has all those letters, like the whole alphabet behind his name. So on that note, from Franklin, Tennessee, Tom Laune, appreciate you coming on the show.
Thank you, Andrew. I really appreciate you bringing me on.
Yeah.
I'm really looking forward to talking with you.
Glad to have you on. And it's a super cool topic that I love to talk about because it's a very eye-opening financial road that you kind of have laid out for people that a lot of people just don't even know that it exists. A lot of times when you think about a financial strategy, we're thinking about stocks and mutual funds and a piece of real estate that make up our pie, if you will, right? And not saying that those are bad, but it's just a unique way that you go around setting it all up, per se. Is that a good definition?
Absolutely. I think the word that comes to my mind is thinking about who is really in control, right? Yeah. And when you're looking at the stock market, when you're looking at the normal way that people do things, they're taking that control and giving it to somebody else.
Yeah.
And what I'm trying to do is really help people understand how to bring that control back to the actual person.
Yeah. I know that we're going to go over these 3 steps that you've kind of created to simplify the process of Bulletproof Wealth strategy. But before we do that, I want to kind of take a step back because I think that it's important for the viewers to understand where this strategy came from. And the reason I say that I think it's important is a lot of times you may have people that create a strategy or an idea, and it's just based off of an idea. It's just based off of, I think this is a good concept, right? Yours kind of came from an actual real life experience that you saw, you lived through and thought, oh my God, I need to actually help people to go do this, which I think gives it a lot of credibility. So before Bulletproof Wealth strategy, you were in the, I'll say the entertainment business, the musical side of the business for years. And there were some huge names in the industry. Kind of back us up and tell us a little bit about how it all came together.
So I was in the music industry for 29 years, and I was an engineer and producer. So the thing that I actually did was I was the behind-the-scenes guy, and I ran those giant consoles that you would look at and go, oh, that looks like an airplane cockpit or
like
something.
Star Wars looking
exactly.
thing.
So I was the guy, really. The truth is, I was trying to make the artists look their best, and I was trying to make the artists bring their vision out that they had, and oftentimes get them to a point of exceeding what they thought they were even capable of in terms of their songwriting, their sound. I can't tell you how many times I've played a final product for an artist and they've said, man, I had no idea that I could ever sound that good.
I sounded that good.
Yeah, exactly. And so it was really a great career. Of course, that career relies 100% on your hearing, right? It is all about just listening and trying to paint with sound. Really, that's what you're doing, is you're coming up with small nuances of how loud is the hi-hat, how loud is the kick drum, how loud is the guitars, how are they all playing together, balancing off of each other. And so without that ability to paint like that with sound, you really can't do it. So towards the end of that, I started to experience high-end frequency hearing loss in one ear, and I was not able to do that. Thankfully, and I mean, I'm so thankful for this, but 20 years earlier, I had a financial advisor say, hey, you know what? You're making a really good living in music, using your ears, you need to protect the ability to earn that living. And so he set me up with a disability policy that was specifically on my hearing.
Yeah.
So I was so thankful. Now, I kept that thing in force, mind you, for 20 years. And eventually I had to use it. And when I had to use that policy, I could have just quit working and it would have paid for life. It would have just paid forever, because it was back in the day when they sold these things called lifetime extension riders, which is like, they don't even have those anymore, but I bought one. And I could have left that go, but in reality I thought, you know what? This has been such a huge impact on me. That's when I decided to go back to school, you know, and get all of these financial designations that are all of the alphabet soup behind my name now.
Yeah.
So just for your audience, I'll tell you, I'm a chartered financial consultant, a chartered special needs consultant, and a chartered life underwriter. So, and I'm working on a retirement income planning designation as well. So there's a lot of financial education I have, and a lot of times, Andrew, people skip that part of it. For some reason, they think, hey, I'm just going to go start trying to do this before I really learn what I'm doing. And I kind of did it all different. I spent 4 years just, you know, taking massive amounts of tests, you know, and going through all of this stuff to learn what I was doing before I created my Bulletproof Wealth strategy.
Yeah, that's why I wanted to take a moment to talk about it before we go through the Bulletproof Wealth strategy, because I think there's a lot of authority and credibility behind the process you went down versus a lot of maybe perhaps other people that kind of go get their insurance license really quick and then they start doing this.
Yes.
And what we're about to talk about, it can be it's a high level and it can be confusing.
Yeah.
To a lot of people. What we're going to talk about is not your typical term policy through here. And I think that there's just a lot of credibility behind the way that you did it and that you went through it, right? Me and you were talking earlier, I traveled and spoke forever, and I realized somewhere along the line that, man, if I lose my voice, I will not be able to make a living with what I'm doing. And I went and got a vocal disability insurance policy.
Mm-hmm.
Thankfully, I never had to use it, but it did give me an absolute peace of mind that if I lose my way to make money, I will be able to continue. Now, that's not what, if you're listening, that's not what we're going to spend all of our time on, but it just kind of tells the background story of how it all came about. So, you work in the music industry, which is probably why you were somewhere close to Nashville during that time.
Yes.
It kind of tends to be a hub of music there.
Yeah.
And you lose the hearing, you go through the disability, you go back to the school, you get the degrees in the financial world, and along that road, after that road, you start the Bulletproof Wealth strategy concept. All right, let's now break that down to understand what it is and how it works. I think you said there's three steps to it.
There's really just 3 parts to it, and the first part is protecting your ability to earn a living, because frankly, if that breaks down, then everything else goes. People don't realize that that is the foundation.
Yeah.
If you cannot earn a living, you're not going to be able to make any of this other stuff work. So I try to protect people at the highest level possible, and the first step is, do you have disability insurance that if something were to happen to you and you couldn't work, that you would be taken care of? And by the way, that is tax-free. That comes to you as an income, because you pay tax on, the way the taxes work on that is you pay tax on the money before you pay your monthly premiums for disability, and so when you get the payout, that is all tax-free completely.
And that's another huge component of what we're going to talk about today is the tax benefit side.
Yes.
And there's also an asset protection side.
Absolutely.
Into these two things. So we're going to go pretty deep on not just the financial world, but those other steps there, because I've always said when it comes to wealth, I break it down into 3 categories, which is wealthy people know how to create money, wealthy people know how to keep their money, meaning they understand the taxes and the tax benefit structures of things, and they know how to, lastly, know how to protect their money. When you find a wealthy person, they can talk to you about those 3 things over and over and over again, because those are the 3 pieces of the pie to understand money. You'd have to understand how to create money, you have to understand how to keep money, and you have to understand how to protect money. One reason I love what you do is because it hits all of those.
Yes.
It really does hit all 3 of those, right?
Yes.
And this first kind of component here, the disability side, if I'm just a viewer listening right now, and I'm going to throw a example to you perhaps. If I'm a viewer listening and I'm thinking, okay, disability, hey, that does kind of make sense. I run this, I'm an entrepreneur and I run this hair salon. I'm gonna make something up here. Right? I run this hair salon, and I own it and I manage it, but I also cut hair all day and so forth. Does that type of entrepreneur need a disability insurance?
Yes, because if they are actively doing something, then the only type of income that you cannot protect is pure passive income.
Right.
Where you're not doing anything and the check's coming in the mail whether you work or not.
Well, let's talk about that then. What about a real estate investor, right? We have a lot of real estate investors listening. Mm-hmm. If they're out there flipping houses, they're wholesaling, etc.
Yeah. Can I just tell you, Andrew, that one of the myths is that wholesaling is passive. Wholesaling
furthest thing.
It is the furthest from the truth, man. I mean, it is like you are actively
You're a hustler.
Hustling.
Yeah.
Yes, you're hustling. So yes, that income,
all those you would want it.
Absolutely. Yes.
Yeah.
Those people need to work. The only type of income that cannot be protected is, let's just say, if you are in a syndication and somebody else is GP and you're just a minority LP and you are doing nothing other than just putting money in, somebody else doing everything, that income would not be able to be protected through a disability policy.
Gotcha.
They would just take your passive income minus your active income, and that would be showing what it would do. So
from your bulletproof strategy, steps kind of phase one, if you will, is set up your disability insurance. And in a broad stroke, 99% of everybody out there needs a type of disability insurance.
Yes.
You are proof in the pudding, which is how you got started.
Yes.
Without that, you wouldn't be here today teaching this. But you need that disability insurance. From when I had mine, it really wasn't that expensive. From my perspective, I mean, it's all relative to everybody that's there, but it wasn't a super high end. It wasn't like some $1,000 a month type of product that I had, at least when I was doing it. But that's a disability, and it kind of pays you on a monthly. If you have to use it, it pays you on a monthly basis for a certain amount of time.
Yep, and that is the key, is the certain amount of time. So most policies these days, the longest they can stretch to is age 70. So if you're in your 40s, that is a long time if you become permanently disabled. You can get them that they only go 2 years, 5 years, 10 years to age 65, 67, or 70. But the reality is that what we're trying to guard against is long-term disability. Short-term disability is a whole nother topic, and it is really from 0 to 6 months, and that is not what I do at all, because I'm looking for the long-term. You need to have like a savings plan to cover those first 6 months. It's like a nest egg.
I'm not 100% in support of everything that Ramsey talks about, but one thing I do agree is that you should have that 6 months in reserves, setting aside.
Yeah.
And that's about anywhere you're in life. You should kind of have that money liquid and available to you at a quick notice. And that's really what the 2 to 3 month disability process is really for. What you're talking about is that legitimate, God forbid you got in a car accident, you lost your hearing, whatever it may be.
Yes.
All right, so this is kind of phase one of it, which a lot of people never even look at. And that also gives you a massive peace of mind. I think it's the one thing that people don't think about and understand until you have it. It just gives you a legitimate peace of mind at night when you go to sleep.
Yes.
Know that your family and so forth, you didn't pass away, you're still here, but you just no longer do what you were doing, but the bills are paid for.
Yes.
All right, what's step two?
Step two is, I call it my option strategy. And what that does is it captures your insurable interest. So this is the thing that people don't understand, and it's a really eye-opening awakening here when they finally get their head around this. But the reality is that you can only buy so much life insurance. And the amount you can qualify for is based on your age and your income. Okay. So the older you get, the less amount of insurance that you can purchase. So as a young person, let's just say you're below 40, you can actually purchase quite a bit more, and as you age, that amount goes lower and lower and lower.
Okay.
So what I try to do with my option strategy is capture somebody's ability to own the product in the first place. And I do that with what's called a convertible term insurance policy. So sometimes we start with part convertible term, part whole life, which is the third leg of this stool, depending on how somebody wants to structure their plan. And also, the option strategy is largely determined based on what someone's risk profile is. So if somebody has 5 kids and their wife is a homemaker and they're bringing in all of the income, I call that a very high risk profile individual. And if they're single with no kids, they're a low risk profile. They don't need as much of their income replaced. So one of the things that I love to teach people is, why do you need life insurance in the first place, or why do they allow you to buy it? For example, if you had a $20,000 used car, you cannot go buy a $200,000 auto insurance policy on it, hoping that if you run that thing off the road, you're going to be able to go get a nice, high-end Tesla. It just does not work that way.
Right.
You can only insure something for the value of it. So in life insurance, what they're keying on is your income. They're looking at your age and your income, and that determines how much you can purchase. So what they use is what's called a 4% income replacement ratio. And that means that if you, for example, were earning $200,000 a year,
Okay.
then $5 million of life insurance paid to your spouse, if she went and put that in Edward Jones or someplace and said, I need a conservative 4% return, that would replace that $200,000 income. Because 5 million times 4% is 200,000. So that is a really important leg of this stool, is to capture what it is that you can qualify for now. Because listen, people don't realize this, but as you move forward, people generally get less healthy,
Right.
and sometimes something comes up that will make them uninsurable. And so I try to make sure to grab it while you can get it. Does that make sense?
So this is going to be for a now we're moving into death benefit.
Death benefit, yes. And this is convertible term. Now the convertible is the key to it.
Okay, go through that side of it.
Convertible means that you can, what this has is a 20-year conversion privilege to allow you to switch it into the third leg of the stool at any time you want.
Okay.
So the third leg of the stool is where we're completely reverse engineering insurance to put in the most amount of money possible for the least amount of actual life insurance purchased, whereas convertible term insurance is putting in the least amount of money for the most amount of insurance.
So on this phase 2, leg 2 of the stool here, is you're trying to buy convertible insurance, which is going to allow you to, the purpose of it is to allow you to replace that your income for your family.
Yep.
Based off of the kind of the 4% rule.
Yes.
Of what do you have there. Now, one question I have is, like, let's talk about entrepreneurs, real estate investors right now. A lot of times entrepreneurs or real estate investors try to live that their income is showing the least amount of money possible
Yes.
on their tax return.
I know they
Right?
do. I know they do. Yes,
So-
they use that bonus depreciation. They try to get the cost segregation study going, and they
Yep.
try to get this thing down to
Donations
I make
and-
no money at all.
Maximize as much as they can. And so here you have this person that he's only showing 50 grand a year
Yes.
of income. In
Right.
reality, he's doing way more than that. How does that, for him, does that mean that he can only get the 50 grand on the insurance?
No, because what I go on for this amount of money, what the insurance companies will allow me to use for real estate
Okay.
investors is your gross income minus your business expenses. So now I will tell you, like in the world of wholesaling, sometimes their gross income is like, $1.2 million, but they have $1 million of advertising expenses to get the cards in the mail, to buy the spots on Facebook,
Right.
and to do all of the advertising that they do to make their business really run. So if you are in a situation where you're making 1.2 million and spending $1 million, then the amount of income that you can replace is that 200,000. Most people, though, in the real estate world are their gross income minus business expenses is not that big of a disparagement. It's not that big of a difference. So it'd be like if you make $250,000 and you use $50,000 for business expenses, then we can replace $200.
200.
Yes.
And this is probably more of a CPA question, but I'm thinking I use a lot of the art donations that we do, where we donate high-end art and get a massive tax write-off. On that side of stuff, my question I'm wondering is that fall under the business expense side, or is it a third bucket that I could use it before I do that?
And that is a question for
CPA.
CPA.
Yes. What bucket does that fall underneath right there is what my brain was thinking.
Yeah, it's a good question. But
once you do it one time, let's say that you set this policy up, again, just looking from a viewer standpoint, I set this policy up, we'll use the number that you talk about, 200,000. 3 years later, I'm not making 200 grand. Maybe my income took a major dip. I had a huge loss that you only made $80,000. Do they reset it year after year?
That's a great question. So both with disability and with life insurance, the only time that they look at your income is at the time of application. So you can qualify based on your current income, and if it goes down, as long as you keep that thing in force, you're good to go. They cannot take it away.
Okay.
So you don't have to worry about
So
that.
it's the one time, so later on if you have an income loss, you have to reset it every year and keep it there. That's a great point there.
One-time snapshot.
So on this one, you're trying to pay, if I'm saying this right, in this leg, you're trying to pay really as least amount of money as you can on a monthly basis for the highest amount of insurance on that side. And this would be, again, I pass away, my family would receive it, and they're going to get this 4% rule replacement concept there. And they would get the lump sum. They're not going to get a monthly stipend. They're going to get the lump sum. That lump sum, the 4% is saying go invest that in wherever you want, your dealer's choice, and you're trying to replace the 200 grand that you set up.
Yes.
Now that sounds a lot different than a typical life insurance policy.
Well,
is that because it's convertible, or
what is the difference? Is the conversion privilege. So a lot of times when you buy life insurance through a stock-owned company, they don't have anything to convert to.
Okay.
So they might have one crummy, guaranteed universal life policy or something. I'm thinking of just the typical big box stock, owned companies. They just don't have the specialized products, and they can't design them in a way that would really, give you great cash accumulation, because that's what the goal is. Okay. So you have to buy the convertible term policy through a mutually owned company.
Okay.
And it has to have that conversion privilege. So that's why
And not every life insurance company out there offers the convertible life insurance.
They don't. And a lot of times they'll limit it. Like they'll say, here's a 20-year policy, but we're going to limit the conversion privilege to 5 years or 4 years or 2 years or something like that. So anyways, getting one with a full window of the 20 years is really important for that second leg or that option strategy.
And that would lead into the third leg of why it's important. Before I go there, I have one more question. When someone receives, they pass away, they receive that money, their family does.
Yeah.
This goes back a little bit to the tax side of it. Mm-hmm. Is that money right there also tax-free when it goes down to their family?
Yes, it's the same as disability. So you pay the premiums with after-tax dollars, and then the payout is coming to your beneficiaries tax-free.
Yeah.
So it's really a great play for taxes. You can basically really leverage your, what you're able to pass along.
Yeah. And when they received that $5 million in this example, tax-free. In a convertible note, I know you were talking about 20-year here conversion. Just to make sure for the viewers, would a convertible insurance policy be in existence until that person passes? They live to 84?
So a convertible term policy means that you have a 20-year window to convert it. So if you bought it at, say, 45, then you would have till 65 to convert it into a different product. So you only have that window to do it. The reason we do that, the reason I do it, is because every single person asks me, hey, what happens if 5 years from now I'm loving this whole concept of cash accumulation and the benefits of doing that inside of the whole life type insurance, what if I want to add more to it? Well, the thing is, this second leg of my stool gives them the ability to create a bigger policy in the future without having to go back and be re-underwritten medically.
Okay.
That's what makes it
so
so
now they
cool.
can be older.
Yes.
As well.
Yes.
Okay. And I think last question I have on this one is, if someone, and maybe I should do this after phase 3, but my thought is, if someone got to phase 1, phase 2, and they stayed at phase 2 and never did phase 3, is there still benefit in doing those first 2?
Yes. Well, for one thing, there's always a benefit in phase 1. That's a disability protecting your income.
Right.
Phase 2 is protecting your family for a limited window of time. So, for example, if you have young kids that are 2 years old, after the end of 20 years, they're going to now be 22 and be out of the kind of nest, so to speak. So that's even in and of itself, if you didn't do anything else, that would protect your income for the time that your kids were young. Mm-hmm. So there is a benefit there.
And is a convertible, is it taking more of the form of a whole life type policy versus a term?
So the convertible is a option on the term policy. So you can buy non-convertible and convertible term insurance, and what that means is that you switch it from one type of policy to another. And you also, by the way, get a credit for your last 12 months of premiums that you put in when you do that. So if you had a $4,000 a year term policy and you were going to put it into a $75,000 a year whole life policy, then they're going to give you that $4,000 as a credit when you do that conversion. Does that make sense, Andrew?
Yeah, because obviously, just from a viewer's perspective here, when I hear the word term, I think it doesn't cost a lot of monthly money. The monthly is low, right? Like I remember for a while I had a $1 million term policy, and just where I was at age and so forth, I think it was like, I don't know, $150 a month or something like that.
Yeah.
Is where I was with it. And then in the past, I've had $1 million whole life policy, and that was more like ballpark. Remember, like maybe $1,000 a month.
Yes.
For $1 million whole life, right? And there's a lot of advantages, disadvantages to both of them. With what this convertible is it more along the lines of the term side of like the $150, or more like the whole life of $1,000?
It's more like the term side of $150. In fact, the difference in cost between a convertible and a non-convertible term insurance is almost nothing. It might be $154 versus $150 to add this really cool feature to it.
But it is based off of income.
It is still based off of income. That's how you can determine how much your death benefit is.
Because if I remember when I got my term, this is a long time ago, but when I got my term, that was not based off of my income, I don't feel like.
Well, that is where a lot of people go, oh, just do 10 times your income and you'll be fine. That's not how I do it. I do it on an income replacement basis, and that's how the insurance companies qualify you.
Yeah.
So however much income you make, like for example, Andrew, somebody making $100,000 cannot go buy a $40 million policy.
Yeah, no way.
It's just not possible because they say, no, that's over the amount of income that you need to replace if something were to happen to you. Right, just like my car example. So it is based on your income.
It's funny because, and again, this was just a while back, I'm trying to figure out why you wouldn't set up on a term type policy strategy, let's just call it, a convertible note with it. I mean, a convertible insurance, because it's, to me, like I can immediately, without living in that world, but immediately see the immediate value of having a convertible policy versus a non-convertible policy.
It's way better, and so that's why it's very important that we set you up with the right type of policy from the right company, that both gives you the conversion privilege and a great product to convert into.
And why do you think a lot of the insurance people don't set it up that way?
To be honest with you, Andrew, there's just a huge amount of misinformation that gets out there, and people don't understand how this actually works, and they don't see it long term with an end game. They just are trying to, I don't want to be crass or anything, but they're trying to make a quick sale.
They're trying to make a sale. I was about to say it because and that's not in just that industry, that's in so many industries. And we could talk about real estate for a second here, or mortgage. Someone gets a mortgage license, someone gets a real estate license.
Yes.
And I think it's harder to get a insurance license, but the theory is still there. In the example of it, real estate agent gets their license, and they take these 6 weeks of classes, and poof, they got their license.
Yeah.
They know very, very little actually about real estate, and is this a good purchase for the homeowner at that time? But they're out there selling houses because they have a license now.
Yeah.
And kind of the same role in mortgage side and so forth, so on. And I think insurance kind of also has that same thing where sometimes I'll see my buddies, get their insurance license, and the next thing you know, they're on Facebook telling everybody why they should have a policy. I'm like, where were you for the last 20 years if it was so important,
Right.
You just got it, and now you're trying to, push it off to everybody.
Right.
But I like this convertible insurance because just in business in general, I like flexibility with what I do. And, I'm thinking back when I had the term, there was no flexibility. It was pay this or you have insurance, or pay this, don't pay this, and you don't have insurance. And I had no convertible side to it. And I think where you're headed, this is going to become extremely important on this next leg here.
Yes.
This convertible piece. So let's get into phase 3 of it now.
Okay, so phase 3 is where we're taking either your convertible term policy in a few years, and we're converting it from the least amount of money for the most amount of insurance, just the opposite. Now we're putting in the most amount of money we possibly can for the least amount of insurance. And you have to say, why in the world would you do that? And the answer is for the unbelievable advantages of having money in this asset. Okay, this is like literally like you're purchasing an asset, like you're purchasing a home. And for real estate investors, I like to break it down of, okay, what is going on with why are you able to borrow this money and how does it work? And it works just like equity in a house. So if you bought a $500,000 house and you've paid $200,000 down on it, now you have $200,000 of equity in it. So now you can get a home equity line of credit. Well, that is cool. And then you could leverage that home equity line of credit and put it into another asset if you wanted to do that. But there's a lot of issues with that being your primary place that you're pulling money from. And so this works very similar to that, only it has a lot more advantages. It has tax advantages. The internal growth inside of this specially designed policy is taxed on what's called a first in, first out basis. So the way that I explain that and break that down is that if you bought $100,000 of Apple stock, and then that Apple stock went up to $200,000, so now you're doubling your money. If you sold $100,000, that would all be capital gains.
Right.
So if you took your winnings off the table and sold that 100, you're getting taxed at, pretty good rate depending on your tax bracket, and it also depends on your holding period. It could be either short-term or long-term holding. So that is because you're taxed on the last money out. They call that last in, first out taxation. So with life insurance, the money that goes in there is based on first in, first out. So if you had $100,000 of basis in your life insurance policy and it grew to $200,000 inside of it, if you sold $100,000, you'd be pulling that basis out at 0 taxes. Now, I structure it to where in retirement that once the basis is extinguished and you have no more of your own money in it, then we switch to collateralized loans through the balance of retirement, so you never pay taxes on it again. It's really amazing how it works. And the beauty of it is you end up with this massive, sometimes $10, $15 million plus of policy growth inside the policy. And all it does, it gets paid off. If you have for example, a $15 million face value at the end of your life because it grows over your whole life, and a $10 million loan, then the loan gets extinguished when you pass away and the beneficiary gets the balance of that $5 million. Does that make sense? So it all works perfectly.
Yeah, this is moving into the people call it infinite banking. People call it bank of you,
Yeah.
banking on you. There's a lot of different terms here.
Yes.
Is there anyone that you kind of lean into, or?
Well, okay, so I'm an authorized infinite banking practitioner, so definitely I feel like they have the most legitimacy. I personally have issues with Bank on Yourself because it gives you the impression, reading that book gives you the impression that you're borrowing your own money. Okay, and that is where people get confused on this whole thing.
Okay.
Is you're not borrowing your own money. Like, think of it back to a house, Andrew. When you take a home equity line of credit, are you borrowing your own money from that equity line? No, you're borrowing the bank's money,
Right.
and they're collateralizing the equity in your home to allow you to have a line of credit to be able to borrow their money at a very favorable rate, okay?
Right.
This is the same thing, only you're borrowing against your money. It's the equity from your policy is what is utilized. Now, why is it so cool? Is because it goes up every year, compounds and grows every year. It just keeps going higher and higher. And your line of credit increases every year. Every time you put money in, your line of credit goes up. And usually the way that I structure these deals, by the fourth year, it takes a little time because you're essentially starting your own banking, really your own privatized bank is what you're starting. But by the fourth year, if you put in 50 grand, for example, that increase inside your cash value goes up by more than 50 grand. So you're essentially then every year you put in money, it's going up by a larger amount than you put in. And it goes up crazy. By the 20th year or so, you're usually doubling your money that you put in. So if you put in 50, it might go up by 100. And then it just keeps going from there. Every year you put money in, your increase is compounding.
So I've heard people talk about this. I've heard many different points on it. And some of the points I've heard is you should put all of your money you possibly have inside of it.
All right.
And the kind of their approach was even your monthly household expenses, all of your money should go inside of it, and then you're taking a loan back out against it. Is that what you're saying, or is it a different approach from that person?
So my Bulletproof Wealth strategy is not saying that.
It's not saying that.
No, I'm saying that what you're doing is you're creating a privatized bank for which you have a place that you are going to be able to use that for investment purposes. So if, for example, you're taking a loan at 5% from your policy and you're investing it in something earning you 15%, that's a phenomenal use of that money, okay? Because you're actually getting into the big topic here, which is how banks make money. So that's what I really love teaching people, because that's where all of the excitement and sizzle in this concept is learning how banks make money. So if you have access to 5% money and you're making 15%, let's say you're making 15% in a real estate syndication or something that you're doing, you're actually taking a 15% return and, believe it or not, turning it into a 200% return by using this concept called arbitrage. So that is where it really gets exciting. Now, if you take that money and use it to buy groceries, you're not making any money on the groceries. That does not make sense to me, because now you owe back the loan at 5%, but you've spent it on something that was consumed, right? So I don't recommend to my clients to take trips around the world, although they could do that with their money if that's really what they want to do, but realize they're going to have to pay that back because they took a collateralized loan from the insurance company.
Just like you do on a HELOC, you can take $100 grand out of the home equity line of credit, and you can go on a vacation with it. The bank's not going to stop you,
right?
But you still owe interest on that money, the $100,000, because it wasn't $100,000 cash in the bank.
Right.
It was $100,000 of the bank's money that they gave you collateralized against your house.
Yes.
Therefore, you still owe them their interest rate off of that money. And when you sell the house, you can pay them all back off at one time, but you're still going to owe them that money.
Totally.
So, and that was one of the things that when I first started playing around with this, I got really kind confused by.
Yes.
Because when I first got into it, I was looking at it thinking, man, if I put I remember they were trying to get me to put I forget what it was, but it was 95% of all income that comes into my plate, if you will.
Right.
To stuff it into these different policies and then take loans out against it, like you're talking about.
Right.
And they're like, okay, so if your yearly expenses, making a number here, if your yearly expenses are $120,000 a year, then you'll take a loan out for $120 and use that for your monthly expenses, but your money is still making money as it's in there, and it was just I got to the point where I'm like, it just seems overwhelming.
Yes.
For me to run a life like this and,
Yeah.
and move all these different pieces to go do it, and I'd have to have a full-time assistant who just did that.
Yeah.
And I don't think I'm making any more money now because I'm paying her plus all the interest back inside of it. I think your philosophy is a much cleaner approach to it, if I understand it right, which is you're really utilizing it for multiple things, but it sounds like a big focal point is using it for investing purposes.
Right.
Not a lifestyle purpose, if you will.
Right. So small business owners, for example, some of the best money they can make is by investing in their business.
Okay.
Right. So they could take a loan from their policy, buy equipment for their business, and then make a huge multiple on that. Then they've got this, no problem, they've made way more money off of having access to that capital than they would have if they didn't have that saved up or they just didn't have that bucket. And oftentimes with business owners, the thing that is so cool is they usually have liquidity events happen where they sell a portion of their business or they sell something, and then they can just pay all those loans back at once.
And in that note, when you're borrowing money against it, so let's say that, let me give you an example here. Let's say that there's $100,000 of available line of credit, let's just say call it that I could borrow from the life insurance.
Sure.
I borrow the $100,000. That's a loan, right? And I owe the insurance interest on it, and
Yeah.
let's use the interest rate of 5%
Okay.
that I owe back to the insurance company. Now, one unique part here is my actual $100,000 of cash that I had put in there is actually still in the policy.
Yep, just like your home is still sitting there.
Right.
When you took a home equity loan, you didn't come chop a room off your house.
Correct.
So it's the same
So
thing.
my $100,000 of cash is still sitting in the policy,
Mm-hmm.
and isn't that $100,000 still earning me money?
Absolutely. That is the thing. I tend not to focus heavily on that part of it, but it's what differentiates the whole thing from any other deal. Like, for example, when you take a loan from a home equity line of credit, back to that example, you're paying the bank back interest. Do you own that bank?
No.
No, you do not. Is that bank going to return any profit back to you?
No.
No. So with the whole life policy, the thing that makes this like really super juiced on the back end when you really get into it for a while is this understanding how this works. The company is paying you a dividend. And what is the dividend? The dividend is a return of profit of the company, okay? And so you want to be with a great company that has a great track record, right? And so there are some of these companies that are around 175 years plus, and they return this profit, and it only works with what's called a mutually owned company. So the guy who came up with this, like 20-something years ago, is named Nelson Nash, and he came up with this concept of like realizing, oh my gosh, I'm a part owner of the company, I'm gonna get a dividend, and I can put my money into these investments. So what that ultimately does is it feeds that compounding. It feeds that compounding growth inside the policy. And we just take that money and roll it back into your line of credit. Every time they pay a dividend, it just increases your line of credit. So your line of credit goes up every year, and it primarily is doing this both from new capital injection and the dividend being paid.
And so I don't know if we can break it down this way, but in a broad stroke, in a high level example here, let's say that I borrowed this $100,000 that was given to me by the insurance company as a equity line of credit, if you will.
Yeah.
And let's say I'm paying them back 5% interest. My $100,000 is still making money from the payout dividend standpoint.
Yes.
That's there. And I have heard in the past that those dividends can be anywhere from 1 to 4%.
Yes.
Ballpark. Just they're going to float. It's not a guarantee.
No.
It's a floating number there. But is that in from a ballpark standpoint? Is that about how it sounds and feels?
It does, yeah. So I would say realistically, you might get into the 4% dividend late into the policy.
Okay.
So the larger the balance is, the bigger your dividend's going to be.
Okay.
And it takes a while to get this money built up.
Uh-huh.
This is not a throw $1 million into a policy in 1 year type strategy. You have
Okay.
to dole the money in over time. Honestly, the most efficient way to get money in is annually, because there opens up a lot of flexibility when you put it in annually
Versus monthly.
versus monthly. With monthly, let's just say that you were doing, back to your example of $1,000 a month. If you were doing that, that will just be zapped out of your bank account once a month.
Mm-hmm.
If you're doing it $12,000 annually, you might have the option of putting in as little as $6,500 or as much as $12,000, and anywhere in between. So it gives you flexibility of funding, so that you're not having to just have a hard number that you're hitting. Like, I always create flexibility in these policies.
Mm-hmm.
So a more typical design would be, say, okay, you have a $30,000 minimum and a $52,000 maximum, for example. And then you have $22,000 a year that you can put in or not put in, depending on, you know, how well your year went, what your liquidity is looking like at the end of the year, or when the policy anniversary comes. So that's why I like annual, okay? Because it gives you more flexibility than monthly. But when you put that money in, you're averaging, I would say, in the 2% range on your cash, and there are ways to increase that I do that kind of get into more advanced things, but it has to do with, you want to go with a company that pays the biggest, has the best dividend history, right, of all the companies, and then you want to be able to not impact that dividend. So the way that you do not impact the dividend is by having it seem like to the insurance company that you don't have a loan out, because the companies that pay the highest dividends also recognize whether you have a loan out, and they pay you a little bit less dividend when you have a loan out versus when you don't. And it totally makes sense, Andrew, because would you expect, if they don't have the money, they've given it to you, they don't have the money to invest, how would they pay the same dividend? Right. On that money? There are companies that do that, and they call those non-direct recognition companies. From a technical standpoint, that's what it's called. But all they are doing is lowering the dividend overall, because they're having to compensate for the fact that they're not able to make money when they give you that money. So it's just, there's a lot to how this works as efficiently as possible, but I really work hard to help my clients get this thing just streamlined. And this strategy that I'm speaking of now, where you're taking all of the cash value inside of one policy or multiple policies and getting the maximum dividend and still having the flexibility, starts at a cash value of $100,000. Mm-hmm. So at a $100,000 cash value, we can employ that strategy. It's called a cash value line of credit.
And inside of here, I mean, without going, this takes a long time. This is why you have disability insurance as well, because you talk nonstop about this concept. I mean, if you, as a customer, there's like 1,000 questions that are going to come up, and to understand this, it's not as simple as just saying, go get a life insurance policy. That's not what we're really talking about, although it comes across sometimes as that. But inside of here, you have this where you're borrowing against it, and now I have this $100,000 in my hand. I do owe again, just making it the kind of number here, 5%.
Yes.
I got to pay back, but my $100,000 that I put in is still making me a dividend return, which means it's still making me interest, which is one of the great benefits of doing this, is because your money is still making you money while it's in there. You take this $100,000 and you invest in ABC, whatever ABC is, and it can really be whatever you want it for. Like you said, you could take it and travel on the world if you wanted to. your concept, which I believe the most in, which is use this as an investment vehicle, not as your day-to-day travel money,
Right.
household income. You go, whether it be buy equipment for your business that's going to help your business grow, or whether it be another property or a loan that you're giving out. You make this 15% interest back that year from your investment. You owe your life insurance, again, as an example, 5%. At the end of the year, I have to pay them let's just say 5% interest on that $100,000.
Mm-hmm.
Is that right?
That's correct. That is $5,000.
I owe them $5,000 for letting me use that money, right?
Yep.
Over here, I made $15,000, right? What happens if I can't pay them that $5,000? Whatever happened, my investment that I did went bad.
Yes.
I can't pay them the $5,000. What happens?
So the reality is that they will just let that loan accrue. So
Okay.
it's not like they're not holding a gun to your head. You're not even getting a bill for the $5,000.
Okay.
It's what's called unstructured repayment terms, and that
Okay.
means that because it's this collateralized, privatized bank, they basically allow you to create whatever amortization schedule you want. You can pay back the $100,000 in one lump sum. You can pay it in $100 a month. You can pay it at any schedule you want, or not pay it at all if you can't pay it, right?
Mm-hmm.
If you did something crazy and you lost your $100,000, let's say you put it on a track or something,
Right.
I put a bet on it.
Yeah.
Then you would just have to. That would be worst case scenario,
Yeah, sure.
right? So let's just talk about where the risk is. The risk in my whole strategy is on what investment you make.
Correct.
That's it.
Correct.
There is no other. I couldn't call it Bulletproof Wealth if my internal strategy had a lot of risk associated with it. Really, it's a combination of life insurance and a place to save money.
Right.
Right? So this money savings they're going to get the money back eventually. They're just going to take it out of the death benefit if they have to.
Right.
If it just keeps going that long.
Right.
I never recommend not paying at least the interest. Obviously,
That's what I was going to ask you.
Yeah.
Because I've heard people say, well, don't pay it, let it all accrue, and at the end, the death benefit pays all of it back off for you.
So that is fine for retirement. But during your active investor years, in fact, that's how I do structure it for retirement, is where it just accrues and accrues and accrues, and then it all gets paid off at the very end. And I don't start that until usually age 68 is when I start that kind of a distribution. And then usually the basis takes somebody, which is the amount of money they put into it over their life, to about age 75, and then we start collateralizing loans that are never going to get paid back, starting at around 75, usually going to 90 to 100 years old, somewhere to however long your longevity pattern is.
Okay.
So I know that was a lot of detail, but the reality is that you really want to pay back the interest. That's the key.
Do you want, I'm 38 right now, I want to give you an example. Let's say I pulled $100,000 out, I make this investment, I get my 115 back for my investment. Do I want to? Does it benefit me to put the 115 back? That's what I've understood. It actually benefits me more if I put the 115K back, because I'm going to get a higher line of credit.
That is an awesome question, because you just landed on one of the most confusing things of this whole concept. And that is that you cannot put back more than your loan amount plus accrued interest. Mm-hmm. So in other words, if you took a $100,000 loan, at the end of the year you would owe up to you could pay back up to $105,000. So you have to have a second place to put your profit. Mm-hmm. So if you made 115, now you've got 105 goes back to the insurance company, 10,000 is profit. Now that goes to a holding account of some sort until your next policy anniversary. That's when you can put new money into it. Okay?
In that same original policy?
Yes. But unless you took my advice and got an option strategy, and you said, hey, you know what? I've got $2 million of a specially designed whole life policy and $3 million of optional convertible term insurance. Now we can peel off some of that $3 million of term insurance and create another policy to put new money into that expands your banking capacity.
And you're kind of, at that point, this is where the convertible the original convertible one comes back.
Yes.
Let's say you have this extra. I just gave the example of $10,000 of profit. You peel off $1 million of the $3 million.
Yeah.
And that opens you up a second life insurance policy,
Yeah.
right? Or maybe third or fourth or third, I believe, life insurance policy, because you still have the convertible of $2 million left.
Yes.
You have the original infinite one, and now
Yeah.
you just open a second infinite one.
Yep. So now you have 3 policies total.
3 policies total.
And they just issue you a letter that says, hey, your $3 million policy is now $2 million.
And the reason that's important to get the convertible is if I got the convertible, let's just say at my age of 38, and I ended up wanting to now at 52 open up another infinite banking policy because of the income that I have, I'd have to go through another set of tests and everything else, but now I'm 52 versus 38.
Yeah, and you would qualify for less at 52 than you did at 38 by a large margin.
Yeah.
So you locked in the amount at your highest income multiple years. You locked in the amount of insurable interest that you have. And so you got that going. At 52, you can convert it. And now what happens is your term cost goes down pro rata based on how much your conversion percentage was.
Right.
So if you have 3 million down to 2 million, now you're paying 66% of what you were paying. So the cost of the term goes down, and now you've got another third whole life policy. It really works great.
And this is why people have multiple policies. Is one reason is because you can only put back in the policy what you borrowed,
Yeah.
plus whatever interest you owed.
Yes.
You can't put the 115 in. You can only put, in that example, 105,000 in
Right.
into the policy. That 105,000 now, the $15,000 profit is a taxable amount of money.
It is
that I
because
have.
you made that in the real world, I call it. It wasn't inside the policy.
Correct. Yeah, that was
Yes.
outside the policy.
Yeah.
That was in the real world. You took $100,000 that was borrowed money.
Yeah.
And leveraged it and made $15,000. You took $100,000 of OPM.
Right.
And made $15,000. You owe taxes on the $15,000.
I would suggest you contact your CPA and see if that $5,000 in interest could be deducted. So you may only owe tax on $10,000
of it. There's
Yeah.
a possibility there. But when you put the 105 back into the policy, whenever you eventually death benefit kicks in, that money has grown because keep in mind your original 100,000 was still growing that entire time in there with the dividends that were there. All that money is the tax-free side that comes out on the death benefit side.
Yes.
Am I saying that right?
Yes. So the money that you put in grows inside of the policy, accumulates on a tax-advantaged basis. The way that I do it, you never have to pay taxes on it. And you have a death benefit that's there all the time, and that would be passed along tax-free if something happened to you. I think, Andrew, one of the things that we really need to think about or touch on is why people really need to look at this from a creditor and predator protection
Yep,
standpoint.
I was about to go
as
there
well.
with you. The asset protection side of it.
Yeah, asset protection side of there is huge. So the way that works is that if you have, let's just say you have $1 million now built up inside of there, and somebody were to come after you. Now, the thing I want you to understand is that this is based on state by state. Every state has different rules.
Yeah, it's all a little bit different.
So I go through my clients and show them exactly what state they're in and what the rules are when we get started. Now, for Tennessee, 100%. I'm 99.9% sure for Utah, where we're at now, it's 100%.
I know Florida was 100%.
Florida's 100%, no problem. I know the worst state is California.
You don't say.
I
don't
do,
say.
yeah, I do know that. Unfortunately, it's just not great there.
And what you're referring to here is, let's say you have $1 million of cash value.
Yes.
Inside this insurance policy now.
Yeah.
That's there, and a creditor comes after you for a judgment, a lien, whatever it may be.
Right.
They're coming after you for money, and in a lot of these states, let's use Florida and Tennessee because we know these two for sure.
Right.
And Florida and Tennessee, my $1 million inside of that cash value, face value, it's $1 million of cash sitting as life insurance is untouchable.
Right.
Even if I only owe 200 grand to this creditor, but I had $1 million inside there. That $1 million by state law is protected, and they cannot come after that $1 million.
Yes.
Even though I could stroke a check and pay off their entire judgment, that's irrelevant to the point because that $1 million is protected.
Yes.
Much like 401k money, for a lot of examples,
Right.
it falls in the same category. Life insurance has these laws that hyper protect a lot of it. That's why I love Florida, is because there was a no limitation. You could have $10 million cash value in there. There was one of the states that put no limitation on the cash value. And then they even went a step further in Florida, and even if you passed away, the inherited money that came down to your beneficiary was also 100% protected. And they couldn't come after any of the beneficiary money either. I'm assuming that's probably a state-by-state thing as well.
It's a state-by-state thing. So that is the thing. Insurance is regulated by the state.
Yeah.
And that means that there's very high degree of variance between what one state will do and what the other state will do. And sometimes it depends on who the beneficiary is. If the beneficiary is a spouse, then they give you 100% protection. I don't have every state's laws memorized. It's difficult to do that. But I do have a resource that I go through with everybody and show them what they're able to do.
I think there's a great benefit in the life insurance side from the protection side, from the cash value side, as well as and the unique thing about this one is, if you think about it, the kind of unique part is the cash value side, you could have $1 million in there, go borrow against it. Now you've got $100,000 that you can go invest, but your $1 million is still protected on this other side over here. So a lot of cool value on the asset protection creditor side of it. Anything else on the creditor side that's unique?
Well, that we've touched on the main point, but just the creditor and predators cannot attach that. They can't come after it. So it's awesome, especially for real estate investors.
Yeah.
It really is. Small business owners too, because someone could slip and fall on some business owner's property. They try to sue that business owner for everything they were. Well, if they've been structuring their finances in a way that they have a lot of money in there, they can't get it.
Yeah. It's off limits to them. Again, I did it in Florida, and it was a brilliant strategy that was part of and still part of my portfolio. Is having that there. So, and again, on the tax side of it, the tax advantage that I've always found from the life insurance side is, in a roundabout way, it's like I'm creating a Roth outside of a Roth, right?
Well, most of my clients are phased out of being able to do Roths. Okay, so you have an income phase out on Roths, and then there is the possibility of doing a backdoor, what they call a backdoor Roth conversion. But the reality is that, yes, it's really similar, but not exactly the same as a Roth. It's tax advantaged, I say, rather than tax-free money when you distribute it. But I set it up to be tax-free in retirement.
Right.
So but you have to pay the money, tax money on your income before you put it in your policy. That's why it's the same as a Roth.
Because that's what a Roth is as well, right? When you put the money into it, you're going to pay taxes first and then put the money in.
Yes.
Right. One difference, the Roth is there are ways inside the Roth that you can invest the money and then bring all the profit back in a tax-free manner. But on this one, in a Roth, you're able to put $6,500 contribution, $6,500, $7,500 a year into it. For this one, you could literally put, and that $6,500, remember, you've already paid taxes on it.
Right.
This one, you could put $65,000 in if you set it up this way and qualified for it. And same thing as a Roth, you would already pay taxes on the $65,000.
Right.
That $65,000, you can now make the profit you're making inside of the insurance is the tax-free. Can be the tax-free side. And I'm saying, when I say tax-free, I know you can set it up where they're withdrawing it in retirement as or not withdrawing, I should say that, as borrowing against it in a tax-free way because it's a loan. Mm-hmm. But I'm also talking about it when it passes down to their whoever it is, the next generation. When they receive it, it is tax-free from them when they receive it.
Yes.
Because of the life insurance side.
Totally. That's a great way to put it. So I would love to share with you how I actually used it myself. Would that be something that might be helpful?
Give me an example here.
Yeah. So
Before you do that,
Yeah.
just there's so many questions that are going through viewers' heads right now. Where's the best way for them to get more information? You can't do all this in a podcast.
No.
How do they get more from you?
So I've done a super simple thing here to help people understand this better. I've created a privatized educational series that helps people learn how this works. You can't get it through YouTube or anything. You just go to my website, which is stressfreeplanning.com, put your name and email in, and boom, you get access to this video educational series that is me explaining all of this, ad infinitum. And I'm usually doing it in front of, it's when I go speak at real estate events and stuff, so I record those, and then I put those recordings on my website so you can see me explaining it from a lot of different angles. We talk about how to do this on children, how they can work into the plan. We talk about a lot of different strategies as well.
And what's the website?
Stressfreeplanning.com.
Stressfreeplanning.com. They can go there and get more information from you. And on all three of these phases that you have, I'm assuming if they get to the point they want to buy these, you sell all these, you have access to all these.
So I'm licensed pretty much everywhere. Now, obviously, the limiting factor is you have to be a U.S. citizen. So this is a U.S. product because they have different mortality tables in every country. So I cannot buy a Canadian whole life insurance policy. It's not possible. And a Canadian cannot buy an American policy because it's different. It's complicated, but people live different lengths in different countries. That's why. So anywhere in the U.S. and I can help somebody.
Okay. Let's go through this last example that you kind of have here of how you used it.
So I had a real estate investor come to me and say, hey, I want to rehab this house. And it was right there in Franklin.
Okay.
So I was able to just drive over, look at the area, and go, oh my gosh, this is an amazing area. Like a $1.4 million house right across the street. And this thing he was picking up for just pennies. It was just unbelievable deal. So I said I would lend him $125,000 to fix it up for 12 months. And I structured the deal where it was 3 points at close. So I got 3 percentage points of my $125,000 when we closed the deal. That's $3,750, and then $1,250 a month. So I took that $125,000 from $125,000 from my life insurance policy, and at 5% over 12 months, I'm having to pay the insurance company $6,250 in interest, right? And what am I making over the 12 months from this guy is $18,750. That is the combination of the 3 points at close and the $1,250 a month, right? So it really benefits him. The property is extremely secure. I'm on the deed, and it's a no-brainer of a deal. So I took what would have been a 15% profit and I turned it into 200% because I'm no longer taking my actual money and giving it to him. I'm just doing a collateralized loan. That is the magic of really this thing working in reality. This is what you do. You find places to make more than you're paying. And then you're actually making a massively higher rate of return than you would have if you used your own money.
And if you can find a place to invest at that very moment, you just let it sit there and incur its own interest.
And that reduces stress too, because you're not worried about money's not burning a hole in your pocket, trying to go, oh my gosh, I got to find an investment. A lot of times when people have money in a regular bank and they're earning nothing on it, they're just trying to figure out, where can I place this capital? Where can I place this capital? I've got to do it right now. And therefore, they sometimes don't make the best business decisions.
Yeah, that's one of the great things about this. You can let it sit there, and you're still earning, growing your overall insurance account. You don't have that outside pressure of that we kind of put on ourselves to a certain degree.
Yeah.
Of like, oh my God, I'm not making anything on it. It's like, okay, it's only been 40 days. Relax.
Right.
But there naturally is this thing of like pressure that you put on yourself there. I love the strategy, absolutely, and I love the convertible insurance side, which is a side I haven't thought about before. Because again, if you grab that while you're young, and you're paying at a low monthly interest amount, then at 50, 55, 60, 65, you can convert those without having to go through all the rigmarole of trying to get insurance at 58 now.
Yep.
And paying way more, getting way less versus getting it when you're 35 and having it ready to go when you're there. A lot of caveats there, and I want to make sure that people do not miss that. A lot of caveats in what you said.
Yeah.
You have to do it a certain way. You have to do it this way. You can only do it if it's this. Most people don't do it. Insurance don't set it up this different way. So just for compliance sake, I just want to say that this is probably not your average insurance salesman down the road that knows your uncle's brother's sister and sells insurance right now. This is at a different level that we're talking about, which is one of the reasons I wanted to have you on the show, because your expertise, the credibility that you bring, the authority that you bring from behind it, and you went through it. You've lived it. You saw the benefits of it. You saw how it worked. You saw how it could help you through it. So again, stressfreeplanning.com is just the best place for them to go for you to set them down this path. Obviously, you deal a lot with money, the financial world. I'm going to end it with asking the final question here for Tom Laune. Money is blank. And I'm going to have you fill this out here, whatever your answer may be. Sign it right here. And then me and you will spend a little bit of time talking about why you put that answer there.
Awesome.
There's your Sharpie.
Cool. So I'm going to go with money is control.
Okay.
There you go.
All right, here we go. Tom Laune, it says money is control. Money is control.
Yes.
Let's talk about why you put money is control. What does that mean?
I try to put people in control of their money, and I want to be in control of their money. And this is a way of being in control of your money. Mm-hmm. So it is so important to me to not cede that control to a quote-unquote advisor that is going to just, you're now what I call smoking hopium, right? You're hoping that guy...
smoking hopium, that's a good one.
You're hoping that guy that you're giving all of your money and control to is going to help you make it through retirement.
Right.
Or help bring you to your goals. And I'm looking at taking that control back. Mm-hmm. That's what I'm wanting to do. I'm wanting to help people take control, and I'm really just a guide to do that. I'm trying to be the guide to help people go, how can I control my money? Mm-hmm. And this is a vehicle to do it.
Yeah, I think that it's a great answer, because I think any time in money, if you talk to any type of wealthy person, in my opinion, that person controls their money. It's the exact opposite of what is taught financially around the U.S., at least, let's just say, in the way that we kind of got brought up and it was just pumped down us was whatever money that you want to invest, go give it to someone else. Mm-hmm. Meaning, go give it to a broker, a fund, whatever it is. Go give it to them and let them go deal with it. But if you stop and look at that, for the most part across America, that has not been successful. If you look at the research, the research shows that is not successful. Mm-hmm. If it was successful, we wouldn't have this massive financial crisis amongst everybody. That I think the last stat came out was 76% of all Americans are paycheck by paycheck right now. Wow. And inside of that, it's like that process. And then I read another stat that was saying that less than like 3% of all 401ks have $1 million or more inside of it. And then AARP came out with a stat that said the average American needs between $1 million to $1.5 million to retire. So the math does not freaking add up. If right. AARP is saying you need at least $1 million to retire, and only less than 3% of all 401ks have $1 million inside of it, that would tell you that model is a model that's not adding up at the end of the day. There's something off on that model that's just not working. And again, when you go to the other side of it and you look at wealthy people, they're constantly in control of their money. They're the ones who are placing it where they want it to go versus giving it to someone else and saying, okay, here it is. I'm going to go back to work over here, and hopefully whatever you're doing works, because I have no idea what you're doing. I'm just going to relinquish literally all control for the most part to the other person. So I think if you want to understand money, you'd have to be willing to understand you have to control money.
Yes.
And I think another angle to play off of that is in business, where you see people struggle at is money controls them. It's the opposite of that answer.
Yeah, that's right.
And in business, if money controls you, you are doomed for failure. And I'm not even saying failure in the sense of you may make money to a certain degree, but you'll never find happiness in it because it controls you. And you have to control money. You have to control it in the sense of you cannot allow it to control you mentally, emotionally, spiritually. And if you want to be wealthy, you have to control your money, and you're the one that invests it. The great thing about what I love about the Bulletproof Wealth strategy is that what you're giving them is more of a structure of how to control it.
Yes.
Right? In a very, very safe type of environment, an insurance base. If you know anything about insurance, life insurance companies, banks have failed and life insurance have kept going.
Exactly.
If you guys should go back and study it all the way through the depressions, the Great Depression, banks were collapsing and life insurances were making it through. There's a lot of history behind life insurance and the banking side that I think is extremely unique. We talk about control. So you guys really offer the proper structure for someone to be able to control their money the right way.
Yes.
Which is what I like about it, because it has the tax component, it has the protection component, and it has the control component all inside of it. So again, tax-free, stress-free planning.com is a place that you guys can go. Tom, I appreciate having you on the show, man. It's been a very educational episode for sure. Any last words you have for the audience?
Boy, I really appreciate being here. Thanks for having me. And I would just say that this is not the easiest thing to grasp just on your first listen.
For sure.
That is why it takes a minute, but I can tell you this, nothing in life that is really worth it is just handed to you on a silver platter. You have to be willing to dig through a little bit of the trenches, and there's a lot of gold at the end of this.
There is.
If you're willing to put in a little bit of effort to learn and to watch some of my videos, contact me if you have any questions. It takes a little bit of effort.
You're not going to master this. I've been at it for a while. You're not going to master it on one podcast. I think the purpose of this podcast was a high-level introduction to it. And if it's interesting to you right now and you're thinking, wow, that's pretty cool, but I got 1,000 questions, bingo. That's the one you should now be going to go do the research.
Yeah.
And you don't have to go do the research like randomly start searching for it. Just go to the stress-free planning,
Yeah.
start there, go through the videos, watch the videos. If you have questions, schedule a meeting and get on one-on-one and walk through the process here with Tom. And I do agree with you that anything worth that has a success is going to take some time and effort and energy. If not, we'd all be I can't tell you how many spreadsheet millionaires I've met in my lifetime.
Exactly.
Because if it was just putting on a spreadsheet,
it worked out on paper.
Yeah, then we could go all be millionaires. But Tom, I've enjoyed having you on the show. For those watching the Money Is Show, we'll see you next week on the Money Is Show. This is Tom Laune.